That's right. That's your camera.
You just got it on the screen.
Yes.
There you go.
We're on? Okay, we're just doing camera here. Welcome everyone to another Policy at McCombs, and it's a pleasure to have with us a friend of the university who's been here lots of times, been a sabbatical here for a while, and also somebody that's been working on and off with me since we were like 7 years old or something. So always great to have Pedro Safi from the University of Cambridge here, and good year to talk about his research line of research. He's got a lot of attention in the past few years with the I don't know how to say it. Is it meme stocks? Is that how I'm supposed to say it, with meme stocks and GameStop and all that? But Pedro worked on this has been going on for many years. So hopefully he can teach us a little bit about the good, the bad, and the ugly of short selling. Pedro, thanks for joining us.
Well, thank you so much, Carlos. And hi, everyone. It's a great pleasure to be here. As I was telling some of you, it's the first time since March of last year that I actually get to see people face to face for a talk. So it does feel amazing. And before I start, when I was talking to Carlos about how I should, what should I present and the content, my idea, which I think goes together with the policy at McCombs talks, is to give kind of like, I'm not going to say a practitioner view of short selling, but definitely an overview of what short selling is, all of the market that supports it underneath, together with a bunch of like cool, interesting research results, trying to make sense of what short selling is, how does it affect markets. I'll talk a little bit about regulation as well, and so on. Like many things in life, oops. Suing and accusing, then what do I do? Not what I wanted. So I think I was just pasting, that was the link of the video, but anyway. I hope not. So as many presentations nowadays and things in our lives, Elon Musk always shows up. And that's one of his infamous tweets, saying that short sellers are jerks who want us to die. They're constantly trying to make up false rumors and amplify negative ones. So this is just an example of often how short sellers tend to be vilified by the public, right? I mean, it's a type of transaction that often you see being a bad mouth out there. And if you just, no, I don't know why this is here. But on the bottom right, this is one of Elon's tweets very recently, I think from a month ago, where he's saying, well, you can't sell houses you don't own, you can't sell cars you don't own, but you can sell stocks you don't own. This is BS. Shorting is a scam, legal for only vestigial reasons. So to motivate the talk, I'm going to talk a little bit about what is short selling, how does it work. I'm going to talk about the main baseline results on how it's shown to forecast future prices. I'm going to talk a little bit about how then looking at short selling demand and activity gives us information about not only prices, but actions by firms, by shareholders, and talk a little bit about whether it would make sense to increase a little bit the regulation of the short selling, purely from the point of view of increasing the disclosure requirements of who's shorting or not. Okay, so
this forum here, the answer is always no more regulation.
Well, I know we've been having arguments since we were like 10 years old, so I'm not going to stop now.
Doing this really quick.
Maybe if we, maybe if I just change.
Then go back to it.
No.
Let me see.
Is that your PDF?
Yeah. So maybe.
Let's reopen it and see what happens. Whoops. Why?
Yep.
All right, it's gone.
Okay. Okay. Let's see. Oops. There you go. Okay. So essentially, short selling is a type of financial transaction that allows investors to speculate on prices going down. And the definition of the SEC is that it's the sale of a security that the seller does not own. So whenever the seller has to deliver the securities to the purchaser, he or she will essentially borrow the security, typically from a broker-dealer or a large institutional investor. So short selling is something that is not new. The first recorded short took place almost 400 years ago. I think this Dutch person was trying to short tulips or something like that. In 2019, when I was preparing a similar presentation, I went to the New York Stock Exchange, and there they give us some data on the fraction of trading volume that involves a short seller in one end, and that can of course include high frequency traders and so on. And that amounts to about 57%. Okay, and if you think about what happened recently, actually this will be March 2021, when we had the whole frenzy with GameStop and the meme stocks, one of the reasons, at least, that people circulated at the time, that this was just a consequence of short sellers being caught up in the so-called short squeeze. And I'll talk a little bit about this later. But the next slide is also a fun one that talks a little bit about short selling disclosure over time. And as you can see, I mean, Carlos probably hates this from a long time. In 1802, Napoleon actually passed a decree sentencing short sellers to a 1-year jail sentencing if they were caught shorting. In 92, there was the famous event of the Central Bank of the UK, the Bank of England against George Soros, where investors bet against the pound and they beat the bank. They had to leave the European mechanism, and the bank itself lost 10 billion pounds. And the French finance minister said that during the revolution, such people, the short sellers, were known as agitators and they were beheaded. In 95, when we had the Asian currency crisis, the Malaysian finance ministry proposed mandatory caning as punishment for short sellers, but the beating would be light, similar to the punishment carried out on juveniles. In 2018, during the financial crisis, and this is one of my favorite ones, the Archbishop of York, which is like the second most important person in the Church of England, essentially, he said that to a bystander like him, people that made money shorting shares of Hedge, which was a big bank out there, are clearly bank robbers and asset strippers. The interesting thing about this is that the UK being the UK, of course, there was one of the journalists from the tabloids, looked at the investments of the church's investment fund, and they, of course, made lots of money shorting all of the bank stocks at the time. And this is just an example that brings about the view that I was telling you of how practitioners and people in the industry, they really see short selling in a very bad light. And there are lots of actions whenever they see short sellers trying to short a particular company that drives CEOs to essentially try to fight short sellers, not only through lawsuits, but also accusing them of wrongdoing and so on. This video that I'm going to show you is actually an internal one from Lehman Brothers. When Dick Fold was the CEO at the time, was talking about people that were shorting Lehman and what he was going to do with them.
Fold's unorthodox style of leadership meant it was admired and feared in equal measure. To the floor of the statesman, he proceeded to deliver this fearsome attack on short sellers, the people who were depressing the share price by being short the stock. And he, lucky to everyone's surprise and mystification, he said, if we get this right today, squeeze some of those shorts. Squeeze them hard. Not that I want to hurt them. Don't get that, please, because that's just not who I am. I'm soft, I'm lovable. But what I really want to do is I want to reach in, rip out their heart, and eat it before they die. Dick Ford also had an insatiable appetite for profits, with or without father beans. If you're over 30 years old, own a home in the Austin.
So that's the one. So how does this thing actually works, right? I mean, before we can even discuss whether short selling is good, bad, ugly, and why people hate it in industries so much, let's try to understand how this market actually involves. Remember that in order to short, we need to borrow the security from someone. So if you are the short seller, you would be the someone here on the right. So one of this, whether it's a hedge fund, anyone that wants to short the security. And on the left, those are the beneficial owners or the ultimate owners of a particular security. So for example, suppose I wanted to short GameStop. So essentially there is going to be someone that has GameStop on their portfolios, that would be willing to lend to this ultimate short seller that we see here on the right. In between, we have a bunch of financial intermediaries that tries to match suppliers with lenders, just like in many markets out there. So typically, we have, say, broker dealers that help their clients to find whatever securities they want to short. And helping the beneficial owners, we have the lending agents, which nowadays are big companies like Fidelity, State Street. I mean, the slide is really old, so BGI doesn't even work anymore. Sometimes we have some institutional investors that they are so big that they may have their own lending programs. I believe that TIA Craft, I think, has their own lending program, CalPERS as well. But typically, the reason why we have people willing to lend their shares, right? And you can already imagine that why the hell would I, as a long investor in a stock, give ammunition to a short seller to shoot my own foot and trying to bring the price down through bets? Well, the idea is that lending provides an extra income to lenders. And that's one of the reasons why index funds and ETFs are so cheap, right? There's no free lunch out there. One of the reasons why management fees can be down is simply because our Vanguard Fidelity funds are all making some money through securities lending in order to do so. So using this International Securities Lending Association data, as of December of 2019, we had about $1.1 trillion in equity loans just in the US, okay, which is roughly about 8 or 9% of market cap. And about $17 trillion was available to lend, okay? So from this slide, I just wanted to remember that then we have people willing to lend their shares, we have the short sellers that need to borrow them for delivery, and we have those intermediaries there trying to connect them. Next slide is about the actual mechanics of a short seller, okay? So think here about, I don't know, Goldman Sachs trying to short.
A question on the point you just made. If you are an owner that's long on it, are you the one actively making the decision to land, or the custodian of your stock is the one that's making the decision? You're like, well, I don't care.
So that depends. I think most of us here in the stocks in our portfolios, we probably tick the box in which we give a mandate to, say, Fidelity or Vanguard to lend on our behalf. Some institutions, so a big pension fund, can do the same thing with their lending agents, okay? Or if you are lending it directly, then that's fine. You don't do that, okay? But then, and this is very interesting, exactly for one of the reasons I'm gonna mention now. So remember that then when the borrower gets securities, so suppose $100 worth of a GameStop, in exchange, we need to give to our lending agent some collateral, which in the case of shorting stocks is roughly 102% of whatever amount you want you are borrowing. And on top of this, you also agree to pay a certain loan fee. So it's just like renting the privilege of using those shares, okay? So by nature of the contract, the lender also requests the borrower to give back to the lender any dividends and entitlements that the company pays. Okay, so if I lend GameStop to Carlos, Carlos still, by contract, agrees to give me any dividends that the company pays. But an interesting thing from the governance point of view is that not only, even though the lender still receives the dividends, he or she loses their voting rights. Because again, think about it from a purely contractual point of view. If I'm, for example, borrowing GameStop from Carlos to deliver it to David, David doesn't really know that I'm a short seller or not, right? So he wants to be the owner and be able to vote the rights of whatever he's buying. So as you can see, this leads to a very interesting economic problem that makes that short selling breaks the link between the cash flow rights and the voting rights. We're essentially passing the voting rights to someone else. And so one of the papers that I think I'll have time to talk to you, we actually look at that to see whether institutions really have this trade-off between lending shares to earn the fees while being responsible fiduciaries of their investors to vote whenever they need to. How does that work? The lender in the majority of transactions in the US of equity loans, they have the right to recall their shares at any time. So whenever Carlos tells me, Pedro, I want our shares back, I need to give it back to him in 3 days. And if Carlos requests the shares and I don't have it, that's when we start having these fails to deliver or the short squeezes, which is exactly one of the things that happened with GameStop. One of the things that people circulated is that there were lots and lots of short sellers that started seeing that their position value was losing money, and everyone wanted then to buy shares to return it to the original lenders. And as you can imagine, in most situations in life, if we're trying to buy a lot of things at the same time, price usually goes up. And that's kind of the setup that we have here. So the next slide that I want to show you about is just a small taxonomy of how we actually measure short selling. So what is the kind of data that academics use and that's available to investors out there? The main one that we all use that started being published since 1973 is what we call short interest. So there was a requirement that for each stock on New York Stock Exchange, Amex, and Nasdaq, we have an idea twice a month nowadays of how many outstanding short positions each particular firm had at that certain time of the day. And so if we divide this number of shares by the market cap, that's how we get an idea of the fraction of the market of the stock that's being shorted at any given time. We have no idea about individual investors doing the shorting. All we know is the aggregate amount. So since 2004, we also have something called the shorting flow. So the New York Stock Exchange look at the daily tickers, and then it aggregates every day how much shorting trades took place on that day. And that's kind of where that 57% number that I gave to you a couple of slides ago came from. So in this data, one of the nice things for us academics is that even though we don't have any idea about the short seller, we do have the type of investor, whether the short sellers were proprietary traders, algorithmic traders, retail investors, and so on. So at least this allows us to see among the short sellers, who are the good ones or bad ones at doing so. And since 2006, that's kind of the data that I used on my PhDs and so on, we also have information from the securities lending data market. So rather than seeing how much people are shorting, we actually get information from those equity loans that I was mentioning to you a couple of slides ago. And that's actually a very good proxy to estimate the demand for shorting a particular stock. The good thing about this data is that not only it's available daily, but it's available across the world. So whenever you can think of stocks, bonds, ETFs, sovereign bonds, corporate bonds, everything is there at the daily frequency, even though we don't have any investor ID. One of the really useful things for us is also to have a better understanding of who the short sellers are, especially the big ones. Just like for regular long positions in the stock, if you're really big, we need to disclose to the SEC our block holdings, right? And I think that the number here in the US is anything bigger than 5%, I believe, has to be reported. In the case of short selling, we have no clue. So we have no idea who are the large short sellers out there. So since 2012, after the European crisis in Greece and so on, the European Union passed this union-wide regulation that requires the disclosure of any short position above a certain level. And by short here is any meaningful negative interest in a company counts. So if you're doing this through options, total return swaps, regular shares, if you have a position above 0.5% of market cap, you have to disclose on the following business day. And every 0.1% increase thereafter is the same thing. And the cool thing about this data set is that not only we know the date, but we also know the identity of the short seller. We know whether it's a Bill Ackman, David Einhorn, AQR, a big long short fund. Everyone is out there, which again allows us to identify a little bit is the impact of large short seller positions on stock prices, liquidity, market efficiency, and so on. Just to give you an idea, this then is the time series in I guess hard black of the lendable supply, and that's on the left axis in terms of market capitalization. So notice that around the financial crisis and since then, it has hovered at around 20% of market capitalization. So notice that the number is very different from 100, which is the theoretical limit that could be lent. And this difference is that there are lots and lots of constraints on people that short. So for example, the SEC has these requirements that says that index funds cannot lend more than 30% of their portfolio. We can have, for example, family holdings that they never short. Think about Mark Zuckerberg. He doesn't, I assume, put up his Facebook shares on the lending market. So that reduces the free float available to short. The trace lines capture the demand side. So in black, that's the average. So as you can see, it's pretty stable over time at about 5%. But I also plotted to you here the 95% percentile, which as you can see was really, really big around the 2008 financial crisis. So the top 5% most shorted stocks had an average of about 28. Then it went down as well, market crashed and short sellers reduced their positions, okay? And it's been hovering around 15. This here is the information from GameStop. So a couple of months ago, or actually maybe last month, the SEC released this staff report on equity market structure conditions in early 21, essentially trying to dissect the reasons of what happened to GameStop and so on. And one of them was to look at short selling and see if there is anything that could explain the price increase that came from the short sellers. Okay, so this graph here essentially shows the short interest as a fraction of market capitalization. So notice that even though since 2013, the number of people shorting GameStop was actually quite high in terms of the previous one, notice that by 2020, it really shot up, okay? So the short interest above 90% was only observed historically very, very few times before. And the last time we observed such high numbers were during the financial crisis. So as you can see, this really, really went up. And after a while, with the price increase, we can see that the short sellers actually started leaving and there was a big crash. So one of the then explanations that I mentioned that people were trying to use to justify what happened with the price of GameStop was this short squeeze. Essentially, short sellers being caught with their pants down, they had to rush to cover their position. So everyone wanted to buy shares, and that led to the price going up. And people were mentioned the Reddit rebellion, right? All those people there in the Wall Street Traders Forum, kind of trying to say, well, let's catch the short sellers on a squeeze. If we all buy enough and we don't lend, we maybe can corner the short sellers and make even more money. So in this report by the SEC, one of the things that they did to try to look at that is to look at the buying activity of traders, okay? And in green or blue, we have the total buy volume. So how many shares, what was the volume in terms of million of shares for people buying? And because they are the SEC, they can actually do the breakdown of how much of that is coming from short sellers. So you can see that even though during the beginning of the frenzy, we did have a lot of short sellers buying, okay? It was definitely higher than what we observed before. Notice that those big increases in short sellers buy volume was essentially just following the trend of higher volume overall, okay? So that leads to the conclusion that the main reason of why the dotted line here of the average price of GameStop going up from, say, roughly 30 to about 400 and then down had nothing to do with actually short sellers being squeezed, but simply something that was generated by sentiment. Whether this sentiment was rational because people thought that GameStop wasn't as bad as everyone thought it would be, and that the company was reorganizing themselves, or just because we have all those retail investors that are irrational and crazy and they were just buying a stock without caring for fundamentals. Regardless, it says that it's difficult to argue that short sellers contributed to this run-up. Okay, but again, those figures are just to motivate a little bit and to show you that there's lots of shorting going on, and they can have quite an impact on what happens with markets. Richard?
So your point is just that the actual short sell buying wasn't driving the price. It doesn't rule out that people trying to screw over the short sellers were driving.
Yeah, exactly, right. I mean, and here when we say people trying to screw the short sellers, it could be because ultimately short selling versus a long position comes from difference of opinion, right? We look at the same asset, we may have different information, but we have very, very different opinions about it. You can think that it will go up by a lot. I have a short seller, I think it will go down. And then, okay, like we know, we trade and let's see who is writing then. What the point here is, if short sellers started realizing that the risk of shorting a particular company is high, right? I mean, if I face more uncertainty with shorting itself, the lending fees might be too high, which would depress my profits, or I might be afraid of, say, an increase in margin calls by our brokers. People might naturally decide to just deleverage and scale down their positions and rush to buy shares. And the idea behind the SEC report is exactly to look at this, just to see whether the buying volume of the short sellers was a really large part of the total volume during the crazy days out there. But totally agree, doesn't rule out whether it's just a retail investor saying, let's form a wolf pack to try to hunt down the short sellers, okay? But from a final price impact, doesn't seem to be much of a difference.
This is an indication that you had 90% of short interest in it, right?
Mm-hmm.
So basically the shorter is like saying, come again.
Yeah, and
it's probably their big investors, right? They're like,
yeah, and
the big boys saying, no, come and get me, and you're not gonna be able to, and fair enough, they did, right?
And exactly in order to make this statement, whether short sellers are, say, smart at making money, we need to see whether they can forecast future returns or not, right? So since this was the kind of practitioner presentation, I know that everyone here knows what I'm talking about. I just had this slide discussing, well, how do we measure abnormal returns to begin with, right? And well, if I want to say that someone is abnormal, we need to know what normal is to start. So as we know, we typically pick our favorite flavor of risk factors, right? Whether it's say the CAPM or the Fama French 3 by adding size and value or momentum, liquidity, ESG, whatever. But the idea is always the same. We say that returns are a function of a certain expected return model. And here in the equation, that's just the Fama French with momentum, plus an error term. And we define abnormal, so this alpha, as the difference between the returns of our security and our expectations. If the risk factors are capturing what's going on with the stock, we would expect that the alpha is 0, so they fully explain returns. And well, as we know, if this alpha is 0, there's no need to pay large fees for that. I mean, that's the reason for why we tell our students to invest in index funds and ETFs, simply because they're cheaper and there is no point in even searching for alpha. Again, I know that that's the theory. So what about short sellers? Well, the result that we have is that there is a very strong negative relation between the intensity of short selling and future returns. In the sense that stocks that are shorted a lot today, they tend to underperform. Okay, which means that our basic strategy to make money, a long short, would be what? Well, we buy stocks that short sellers don't care about, and we short the ones that they dislike a lot, and then we look at the alpha. Okay, and in most academic studies, before fees, the alpha of those short selling strategies are crazy high. They're about, I think, 15, 20%. But even if we take into account the transaction costs, so lower liquidity, those lending fees, and so on, they still come out very nicely at around 10%. And from an academic point of view, and actually from an investor point of view, we also want to know, where is this performance, the superior performance, coming from? Is it because of the bad stocks? So can short sellers identify stocks that are going to underperform in the future? Is it because they can identify the good stocks and they just leave them alone? So, or is it a combination of both? And if they do that, what are they exactly doing to generate this? Are they the ones, say, doing detective work to uncover private information about a company that is not yet incorporated into prices? So if you remember the Big Short movie that I think most of us have seen, that's kind of what Michael Burr, the Steve Carell guy, was doing, right? He found out all those phony mortgages that were based out of nothing. And then he started what? Using credit default swaps to try to make money on those until markets realized what was going on. Another alternative is just that, well, maybe short sellers are better at processing public information than we are. Maybe when, say, Tesla or Apple, they announce their earnings, their financial statements, and with the latest earnings releases, they're better able to interpret what will happen with future profits than everyone else. Or maybe it's simply what? Compensation for liquidity. Maybe short sellers provide liquidity to the market, and that's why they can get alpha. And lots of papers have looked at those. So this here is kind of the graphical explanation. So this is a paper by Boomer and co-authors that essentially they look in orange at the cumulative returns for stocks that have very, very low short selling today over the next 6 months. So the cumulative return in red in abnormal terms using this FOMA French alpha is about 3%. And then they look at the returns of the really highly shorted stocks today in the future. So they go down by about 6. So the difference between 3 and 6 is, and minus 6 is about 9% over 6 months, which explains this 18% a year. So short sellers are good at identifying the really crappy stocks that will go down in value when they short. They leave alone the good stocks that tend to moderately outperform. And that's where the strategy's profitability, what the profitability is, not where it's coming from. So this here is also from another paper that Eckert has, that I think he was the chief economist at the New York Stock Exchange for a while. And he got then this data of nice stocks and the proportion of short selling by different types of investors. So look here that even though the non-proprietary institutional trading, prop trading, they all made money in the future. So they shorted the company, and on average, over 60 calendar days, the abnormal return was a negative 2%. The only category that was bad at shorting were individuals. Okay, that was a little bit positive at about 0.5%. Frank?
Question. So, from like a risk return standpoint, if I'm long a stock, my losses are capped at 0. Or if it's short, I could use mathematically infinite.
Yeah.
So is that factored in when you're thinking about the expected returns?
True. So inherently, I mean, shorting is riskier because of there is unlimited downside. On top of this, the restrictions on shorting are also tougher. So as a short seller, you have to put more margin than if you're a long guy, exactly because of this. So yes, and maybe, I mean, that's why it's difficult to talk about a short selling factor, because we really need to think about the general equilibrium here, right? At some point, stocks are in net supply, so someone has to be buying this at some point. And to top it off, we know that on average, the market premium is what? Positive, right? So during most times, I mean, if you short the market, you're definitely going to lose money on average because it goes up, and if you keep shorting, you're gonna burn yourself. So a short seller inherently also is trying to time the market. The aggregate one if you're shorting, say, the S&P, or an individual stock if you're doing, say, this cross, like this pairs trading, trying to say, I don't know, short Tesla and buy everything else if you believe that Tesla is overvalued relative to what they should be. But the main message of this slide is individuals are not super good at shorting, okay? Now, one of the papers that I had actually tried to look a little bit at where this source of returns come from. So even though on average short selling makes money, there are some times in which they lose a lot. So when we started this project, I was actually trying to see, well, do short sellers make money little by little, so every week, or do they make money exactly when markets crash and they get it? So the result that we find is that, in fact, even though this equity low on demand forecast negative returns, sometimes stocks that are being highly shorted actually go up rather than going down. Okay, so for example, during the Lehman Brothers bankruptcy, the most highly shorted stocks that we would expect would be tanking with the market. In fact, they went up by about 2% a day. So if you think you are a hedge fund following this strategy, this is 2% without any leverage. So if you use 3 times leverage like they mostly do, this would mean 10% a day. And that took place over 3 days, okay, which could really kill your fund just because of that. So the way we justify this is what we call the leveraging risk. If you, anytime you are using leverage to bet on something, up or down, so even think about the real estate market, remember that we are faced to what? That if the market starts going down against us, 3 options can happen. We may be required to put more margin by our brokers, or we could voluntarily decide that the risk is too high and then we start to lower our positions. Or it could just be, if we're thinking about a fund, that our investors need money and they force us to close their positions. And because short sellers are typically sophisticated investors, they also tend to use more leverage than the typical one. And that's where this deleveraging risk comes from. So essentially what we're trying to say, we showed that typically around situations of funding illiquidity, when it becomes more difficult to borrow, investors will be forced to not only reduce their long positions, but also to cover their short ones. And that's why we have this weird result that during market crashes, we see the most shorted stocks going up rather than down. So when I first found the result, I actually thought it was an error in my code. So I spent like a couple of days making sure that I wasn't messing it up. But it just shows that if you're shorting the wrong stocks, and by wrong stocks here, they are the ones with this big exposure to this type of tail risk that comes from short selling. That's exactly partially how you are compensated on average by making money. That the alpha of shorting stocks is partially compensated by the fact that sometimes you're gonna lose it. And this is kind of just a visual representation from it. So here on the left, we are using the TED spread. So this difference in borrowing rates that people often use as a proxy for funding liquidity. And you can see that for most of the times, the relationship is negative. So as you increase this shorting demand, returns get more and more negative. But if you look at the stocks really at the tail, at the top 1% by shorting, this relationship becomes what? Positive as they are being, in days in which the TED spread is at the at the top 99% percentile. So when the TED spread increases a lot, that's an example of times of funding liquidity. That's when this negative relationship between demand and returns flips and becomes positive. Okay. Now, the next thing that I want to talk about, if I have time, and Carlos, remind me if I'm losing. Yes, Mayank?
So, kind of, you talk about two sets of results. First one is very well established that short interest can predict negative return. And also you talk about your leverage and risk taker. Now, if we think about the pattern between short interest and future returns, let's say in the past of 1 or 2 years, it's kind of like, would you expect actually the negative correlation between short interest and future returns might be reversed? I heard about some practitioners talking about the short interest is actually not predicting negative returns in the past 2 years.
Yeah, so that's true. I mean, the past couple of years, we know that the statistical relationship has kind of disappeared in them. So maybe it's finally okay, market efficiency doing its magic and people are using this, and then this anomaly is going down. But yeah, but I'll still try to convince you of some, say, depending on the type of securities, where you can still find, say, cross-sectional variation that might bring you an alpha. Maybe you're right, maybe the aggregate result will start to disappear as people are starting to trade this more and more, right? But yeah, fair point, okay? So now, we'd like to move on and talk a little bit then about the contribution of short selling to market efficiency. And here is in terms of liquidity, bid and ask spreads, and so on. So a great example or a great test setup for us academics took place around the financial crisis. And why is that? Well, essentially regulators all over the world reacted to the crisis by starting to ban short selling. Okay, so the SEC right before or right after Lehman Brothers went down, banned short selling more than 1,000 stocks. And that kind of had led to a domino effect throughout the world. So I think actually the US and the UK restricted them the same day. And then countries all over started doing so. And this was so nice for us academics because those bans were somewhat different. Some countries just banned short selling on financial stocks, but allowed other to take place. So we can do a nice diff and diff analysis as long as we control for difference between financials and everything else. On short selling, until the crisis, some countries allow what we call naked short selling, in which I could short a share to, say, Carlos, without necessarily having guaranteed that I could borrow from someone else. Okay, so after the financial crisis, most countries banned naked short selling. So nowadays here in the States, you have this locate requirement. So the SEC requires you to show proof that you have shares that you can borrow before you actually trade. Okay, so what these academics did was essentially to look at those bans. And the main results were that those bans, even though regulators justify them by trying to support prices. The idea is that if we get rid of the short sellers, you are reducing this demand for selling, okay? And hopefully this will support prices. What they find is that unfortunately, this didn't happen. In fact, it actually reduced liquidity, especially for stocks that were illiquid to begin with, like small caps, those without options and so on, ultimately reducing price discovery. The only country where they failed to find this result was essentially in US, for US financial stocks, but that's simply because the day that the US forbade short selling was the same day that Congress passed the TARP. So it's almost impossible for us to distinguish between the positive effects of the bailout with short selling, okay? This here is just to give you an idea of the proportion of global stocks that were affected by a short selling ban around this time. So notice that in November of 2008, almost 85% of global stocks by market cap could not be shorted, okay? This here shows the average bid and ask spread around the world, so around the financial crisis. Notice that around July, so B, that's when IndyMac failed, and C is when Lehman Brothers went down. So as you can see, spreads started to go up as the uncertainty crept in, okay? And what they did was essentially to compare the difference between the average bid and ask spread between stocks subjected to a ban relative to control stocks before and after. And the main result is, as soon as the bans were implemented, we can see that the bid and ask spread for stocks subject to the ban moved up by more than everyone else, okay? Which again, just shows that short sell is actually good in them. It provides liquidity, it allows for revelation. At the end of the day, I mean, just because in many situations, a company or stock markets are subject to bad news, we need to try to prevent those bad news from arising, right? The example when I'm teaching, this is usually almost like that old story of a dam that has a very, very small hole here, and we put our finger trying to prevent the pressure from crashing down. It will just get worse and worse, and at some point, even though I have my finger here, the whole thing will come crashing on us.
So maybe this gets to the story that you're talking about. I'm kind of curious about this from like a firm point of view. So from like the policy point of view, we can see how these bans are not good, but why, if I'm the CEO of a company, would I offer stock and say, hey, this is something you can buy, and when you own it, you can lend it to someone else. You can speculate on its downside.
Mm-hmm.
Do you see companies, or is it possible for companies to ban short selling of their stock?
So they can try to manipulate the supply. So there's a paper by Owen Lamont that actually shows the strategies that companies do. So for example, suppose that Carlos owns 60% of the market cap and I own 40. Well, if I tell Carlos, let's not lend our shares, that would make it very difficult for the short sellers to even try. Okay, so there are lots of strategies to try to control the supply here, especially because in many companies, the ownership is very concentrated in them. And in more general terms, I mean, as we know, there's lots and lots of research that shows how, say, what companies do affect, say, financial markets, whether prices reflect information and so on. But in the past, I guess, 20, 15 years, there's been lots of research on the other way around, on what is the impact of financial markets on the real company, right? Most companies, they need to raise funds through capital markets, so raising debt, issuing equity, and so on. And that's where regulatory concerns could arise. Suppose that short sellers are spreading false information to make your prices lower than it should be. This might prevent what? Efficient investment from taking place, simply because you don't want to raise capital if the value of your shares are below its true one. Okay, so I have a paper that we actually look at how companies might use stock repurchases to fight short sellers, in the sense that if they see that the price is below what should be based on real information, they should just buy back, because that's good for short sellers, for investors as a whole. And the idea also is that if we prevent all types of short selling, we're kind of throwing the water with the baby in it. Because even though we might be banning the manipulators from shorting, we're also what? We are preventing the good short sellers, that they might be uncovering bad information about the company, from incorporating their opinions. And if prices are then not as efficient, that creates this feedback effect that makes investment less efficient and more difficult from happening in the first place. Okay. Now, the next paper that I would like to talk to you about is another reason for where these returns come from, which is short sellers being able to detect things before markets send them. So there's a very cool paper on the JF by Jonathan Karpov, and I forgot, I think her first name, by Lou in 2010, that they actually show that there's lots of money that short sellers make that come from anticipating financial misconduct by firms. And in fact, so this here is kind of the time series of this. So if companies start doing some dodging accounting, some violation of regulations, okay, this might trigger a particular inquiry by the SEC. So they actually investigate what's going on. So what these authors did, so they looked at around 454 firms that were disciplined by the SEC, okay, around 28 a year, and the typical length between them starting to break the regulation and the regulatory concluding proceedings happening was around 28 months. For those firms, notice that when the SEC announces or reveals to the public that they are investigating, returns tend to be super, super negative, as we would expect, right? I mean, the SEC probably waits until they have enough evidence to even release this to the market. So the returns are really, really negative. And the interesting thing is short sellers actually start increasing the short interest on the stock almost a year and a half before this misconduct revelation is made to the public. Okay, so the idea here is that then they uncover problems and try to trade on it. And that's kind of the idea behind those short selling activist funds like Muddy Waters and Gotham Capital and the shorting activists. They really spend their money rather than trying to identify good companies that will say increase sales. They try to identify what? Dodgy ones with crappy accounting. They're trying to sell a long story to the market and so on. Okay, question? Sorry.
The SEC is basically learning from the market. They can just use their short.
Yeah, right. And,
oh, well, I know.
And in a way, that's what they do with insider trading, right? If there is a weird pattern there, they can try to see if people are doing insider trading, but rather than good reasons of uncovering bad things happening, they can just, I don't know, I'm your buddy, you tell me, you give me a tip, and that's how we make money.
Are we sure the information goes that direction? Like, we know the SEC leaks information to hedge funds all the time, so the SEC just being.
Oh, I mean, we already invested. That's too early. That's like 19 months ahead of time.
So
Someone in the SEC spells something out, the first thing they do is not going to start investigations. They're going to tell everybody.
okay, maybe there's a paper right there, but still, okay. Unless we know exactly how the doors are going, if we believe that many of those SEC releases are unexpected, okay, that's kind of the pattern we would see if short sellers are finding something out. Maybe you're right, maybe the insider trading here is between hedge funds and the SEC. That's true. Okay, but the idea is that.
I just make that up. It's been documented.
Yeah, okay. In the papers? Okay, so good. Maybe. Yeah, okay. So maybe actually that's a good thing then to try to, if we have events. Anyway, we can talk about it later because there might be an idea there. The next thing that I want to talk, yeah.
So I cannot remember whether Couple and Low has a control sample there. I cannot remember that detail in the paper, but can I imagine that, there might be cases like Tesla, which many short sellers think they're very tricky accounting issues. They took huge positions and they waited, and SEC never
did anything, yeah.
And then they actually lose a lot of money.
So that's true. I mean, I think this here is kind of like a bias sample because this is conditional on what? On the SEC actually doing something. So those are the ones that, for good or worse, we know that something nasty was going on. So what you're saying, maybe that's related to your research and some of my papers as well, is what happens, for example, when long hedge fund activists target the same stock as the short sellers, right? I mean, if you think about it, hedge fund activists tend to be what? Sophisticated, smart, rich people, just like large short sellers. So if they look at the same company and they disagree, what's going on here? And one of the most famous activist battles was what happened with Herbalife. And those are actual quotes. So Carl Icahn actually said that Bill Ackman is a crybaby in the schoolyard. Ackman said that Herbalife is a pirate scheme. So just to give you an idea, this here is a position that cost Bill Ackman's fund I think, $3 or $4 billion. So in 2012, he announced a 1 billion short position and made a presentation to the market, trying to convince people why Herbalife is a scam. They said, well, the product doesn't work. The only way this company makes money is because of a pyramid scheme. Okay. So a couple of weeks later, Carl Icahn actually announced that he had bought a 13% stake in Herbalife and said that, well, Carl Icahn is totally wrong. That's a good company and so on. And throughout this period, I mean, the FTC, so the Federal Trade Commission, they were essentially investigating what was going on in Herbalife. And essentially in Bill Ackman's report, he said that his estimate of the price of Herbalife was 0 because it was a total scam. But in the end, I mean, and I don't know whether the final ruling was on a technicality or not, but they determined that the marketing practices of Herbalife did not configure a pyramid scheme. So in the end, Bill Ackman essentially announced the position when the share price was at around 32. So maybe he probably started shorting here. But ultimately, when they announced it, it was at 70. So he definitely lost a lot of money out there. So I have this working paper where we actually look at what happens when then they both target the same firm, right? They both look at the same thing. They probably have the same resources to get information, but they really disagree hard on what's going to happen with the future share price. So what we actually find is this moths to a flame story, that hedge fund activists are actually drawn to companies that have a large short selling position. And here we're using that European disclosure data that I told you about, okay? The other way around doesn't work. It doesn't seem that large short sellers are attracted to companies with lots and lots of activists. And we're still looking into this, but our current explanation is that this might be related to the short squeeze risk, right? I mean, at the end of the day, it's much easier for a company to play ball with the activists because stock price go up than to essentially agree with the short sellers that would hurt the CEO's own compensation in the first place. So what we actually find when we look at returns is also interesting, that the abnormal returns of the hedge fund activists, so that alpha there, that previous research has shown is positive, it's only statistically significant when we have large short positions being present, okay? So it seems that the presence of a short seller on your breathing down on your neck, trying to push down your prices, actually seems to be making companies more willing to negotiate with the activists and whatever demands they have that would justify their share price. And our implication for investors from this is that anyone trying to be an activist should pay attention to the behavior of large short sellers on their company. Now, the last thing before I conclude is to talk. I have another paper in 2015 that we try to look at how short selling can help us uncover things about corporate governance and so on. Recall that whenever someone lends a share, we also transfer the voting rights. But the lender has the right to ask back for the shares at any time. So this creates this cool economic trade-off. If I lend, I get the fees. But if I lend, I lose the vote. So right around the voting record date, any major shareholder has to decide whether we should just keep lending or if I want my shares back to vote. As you can imagine, this depends on who we're voting or what we're voting for to begin with, right? If the only proposal on the ballot is, well, what is the brand of toilet paper in the corporate bathrooms? We won't care. We wouldn't care. Our fiduciary duty would be what? To not even vote and just keep collecting the fees. So what we actually find out is that then this supply of shares available to lend actually goes down right before the record date and immediately goes up afterwards, which is consistent with institutions thinking about this trade-off and actually acting on it. And that's kind of what happens in here. Okay, so lending supply goes down by about 10% ahead of the voting record date. Later on, we do some statistical analysis trying to see how much of this supply recall varies with cross-sectional differences in governance, say on pay policies and so on. And just like we would expect, companies that are well managed and governed, they don't exhibit this pattern at all. Investors say, well, this company is well run, so I don't need to really use my voting rights and I should just keep on lending. But whenever we have also proposals that are more important on the ballot, M&A, big director votes, and so on, we actually see them recalling more to do things. So then, just to conclude, the idea behind this talk is to discuss a little bit with you why we should care about short selling. So we have lots and lots of implications in terms of asset pricing and constraints. Remember that the price that we observe out there represents the average opinion of everyone in the market. And well, all this regulatory discussion on constraining the ability to short can significantly affect market functioning, efficiency, and so on. So if we constrain the ability to short, can we support prices? Mostly no. That's what academic evidence shows. I mean, essentially, it's very difficult to prevent bad news from coming, and we probably don't even want to do that in the first place. We'll just be delaying the inevitable. From a regulatory point of view, can short sellers manipulate prices down? In theory, yes, but just like any buyers, right? And I think that's why at some point, I think that the CEO of Goldman Sachs once said that, well, Goldman was doing God's work by actually shorting and buying and so on. In a way, that's what's also at stake here. In the same way that we don't want people to manipulate prices down, we don't want only the over-optimistic people pumping the price up, right? We need some, call them pessimists or realistic people, trying to lower a little bit this over-optimism pressures and being allowed to what? Incorporate their opinions, regardless of whether they're right or not, into markets. And that's why, I mean, having more information on who are those large short sellers in US markets, at least in my opinion, is actually a good idea. We already do that with the large block holders. So whenever someone has a big stake in a company, he or she has to release the stake and tell the intentions using the 13D form. So whether you're going to be an activist shareholder or just a passive investor. And if we want, and knowing what the large short sellers are doing, it's probably a good idea as well. It would allow retail investors to see what those really large investors are thinking about the company on the negative side, which hopefully would improve efficiency. And that's actually one of the discussions that took place, that are currently taking place, especially after what happened with GameStop and so on. So there was a speech by Chairman Gensler 3 or 4 months ago calling out for this. And just last week, the SEC also released another proposal for actually requiring that essentially that all large short selling, I don't remember if it's large short selling positions or short selling positions to be released every day and be disclosed to the market on the following day, every day soon. So there's going to be one of those open calls for comments and discussion. That's probably the direction that we are going. And well, in understanding a little bit, not only short selling, but this securities lending market that goes behind it can also help us, I mean, as investors, academics, regulators, and so on, to make sure that institutions are doing their fiduciary duties, knowing a little bit more about the impact on market liquidity, efficiency, and so on. So that's it from me. I hope I haven't really gone way ahead of time, but thank you so much. Thank you.
Question? Yes. Yes. Actually, Bishop, can you go back one slide?
Yep.
So we'll talk about the big positions disclosure, right? If my understanding is correct, like the large block holders, it's like 5%.
Yep.
But let's say in Europe, it's like 0.5% of the short sellers.
Yeah, so again, here you can say that regulators, they still have their built-in prejudice against short sellers, right? The requirement for them is much lower than for block holders, okay? But at the same time, I mean, it also has to do with maybe with the price impact. But again, without speculating, I agree with you. The requirements would be much lower for the short sellers, which in my opinion comes from this fear that regulators or politicians have about it, okay? And just to maybe give you another anecdote in that, in 2008, right after the financial crisis, I was invited by the Spanish SEC to present my job market paper or something like that. And then I was asking, and this was right after, say, the bans in the US had occurred, and I think 3 months later, Chairman Cox at the time, he released a statement saying, well, knowing what we know now, we wouldn't have imposed those bans again. So I was talking to the head of research there of the Spanish SEC. I said, well, we kind of all know that banning short selling doesn't work. So why the hell did you do it? So what he said is, well, remember that when this happened in markets, the US and the UK banned short selling financial stocks. So anyone that wanted to short banks in the world would have come after what? The Spanish banks that were very big. So he said, we are kind of left without any options. And that led to this domino effect of people banning, even though many regulators didn't believe that this thing would work. Now, last year, when we had the mini crash because of COVID, that happened again. We actually had, I think, South Korea banned short selling, which I think is still in place. In Europe, a couple of countries did so. And it's always the same thing, right? It's kind of like people that get divorced and get married again, which they say is the triumph of hope over experience. We know that this thing doesn't work, right? We know that bans, they don't work, right? I mean, if a company is doing poorly or a market is going down for good reasons, what is the point of banning it to try to just prevent an even bigger reaction once we finally delay it? Okay, that's my take on it.
So just a stupid question, in all the countries in Europe still have their own SEC version? You do not unify this?
So yeah, so there's something called ESMA, the European Security Markets Authority, that essentially they're the ones devising this policy that then has to be implemented by each country. You know that Europe is weird. So some markets, they have to follow the European Union regulations, but there's always some leeway on how to implement these rules and so on. So with short selling, they try to harmonize this. So some countries were already requiring this disclosure. They just say, well, everyone now has to do this to make it easier for disclosure requirements and so on. So Laura had one and then maybe one online.
So 13F, don't they have to disclose their short?
No, so that's the crazy thing. It's only,
Some choose to.
yeah, so actually in the 13Fs, there's no shorting positions. That's why sometimes on words, on CompuStat.
No, that's the data provider.
Yeah, but that's the data provider. But I don't think, no, I know from what I understood, I think it started now in 2018 and 19. It's not NPX or NSAR. One of the new forms are now requiring funds to disclose their short positions. Okay, and now even from 2019, they're lending positions. For the funds, some of them disclose, I know, to Morningstar. Okay, and we have, but this totally optional, it's not mandatory. Okay, and I think that's part of the discussion now, kind of saying, well, at the end of the day, especially given how much long short is going at the moment, it would be useful just to know what's going on. And yeah, but exactly, if you go there on the 13Fs, everything is positive. So I tried to start a project with Adam Reed, looking at this through Morningstar. And one of the most interesting things is that lots of the shorting that takes place now actually uses those the equity swaps. So this is totally under the radar. So when I was doing this project, we actually got the holdings of one of AQR's long short funds. And they had a very big position on Google that just showed up as total equity return. So they don't have to disclose it. So we have no idea. So there might be a lot more short positions being taken that we don't know about.
You're talking about mutual funds. I'm talking about the 13F.
Okay, yeah, but the 13F, I mean, okay, I know that includes like all the qualified regulators, investors, right? Mutual funds on top of everyone else.
I thought hedge funds that were short.
No, they only have to show the long ones. Okay, and as you can see, I mean, this is kind of definitely weird for us academics, right? It would be useful to understand how these funds are making money. Do they make money from the long positions, short positions, and so on? So now we are starting to see some research coming, say, I think, looking at data from China, and I think one in Europe, but that, yeah, someone knew someone at the regulator that gave them the data, and they could look a little bit at that. So I think Dong Lu has a new paper that he looks exactly at this. I think it's actually based on the US data. He managed to get some mutual funds. And I think, Laura, if you go to Edgar, maybe funds are reporting this, but it's not on a structured form. I think actually that the paper is, they applied those NLP algorithms to essentially read every single one and try to extract the information to build this data set. Okay, so maybe you're right, maybe it's there, but at least on what we observe in the 13Fs on WRDS, it's not. Okay, yes.
Online question I'm going to ask you. So
And should I stop sharing here? No. Hello?
Hi, I got I noticed that Patrick Byrne, on his way out, Overstock, issued a digital dividend, which was intended to whack the short sellers who he blamed for a lot of his problems. But I wondered, to what extent can firms mess with the short sellers by either manipulating dividends or doing other things?
So I think, I mean, ultimately, this is a coordination problem, right? So if the firm itself can convince enough shareholders to get together to restrict supply, that's when they can try to perfectly legally squeeze the short sellers and make life more difficult for them. The other thing that many companies actually do is just to do what often happens here in the US, right? They go to court and they sue the short sellers, saying that their opinions are essentially slandering the firm without having any merit. Okay, and as we know, sometimes just the threat of regulation and the costs involved with it are enough to make people back out. So I'm sure that lawyers are smart enough to come up with these fancy ways, exactly trying to help companies to defend, whether it's through, say, these dividends. And if you think about what happened maybe 80, 90 years ago, when we had the whole corporate governance movement, where companies were essentially using those poison pills and doing all those tactics to make, say, M&As or acquisitions more difficult to take place, and ultimately hurt shareholders. With short sellers, the same thing. There are lots of strategies that companies can do to try to achieve the same aim that would be perfectly legal in that. Okay, and I don't know if I answered your question completely, but I hope I did. Carlos?
Is there any evidence or any research on the importance of short selling as you get the industry moving more and more towards indexing? The more indexing there is, the less trading potential there is, and the more difficult price discovery becomes. There's a paradox, right? Everybody indexed, then all of a sudden there's no price discovery.
So there's
is there an extra importance of short selling?
So there's a lot of short selling being done. So one, you can short ETFs. We actually have an expert here in the room that does that. That try to look exactly whether. One of the things is.
But if everybody's holding, if I index, right, there's no trade. That's clearly extreme.
Yeah.
Forget the mechanism, but like if everybody decides that no, it's stupid to trade, that's it. So the more and more people go into index, you have now fewer and fewer traders potentially, right? The price discovery mechanism, market making aspect of it becomes more constrained. Now, maybe it's not to a point where it's a problem yet, but I would expect that the ability to go and borrow from the ETFs.
So yeah, here there are two things. So the first one is actually the presence of passive investors or funds and ETFs actually change the supply. So research has shown that because they care much less about the ups and downs at the daily level, they say, well, I'm here for the long run, so let's just lend and make the money. So they're more willing to increase the supply of shares than, say, regular active ones, which helps with liquidity. So when I was visiting Austin, maybe in 2016, there was an event here where I think maybe Laura, you were there. I don't remember whether it was like Cliff Asness or the guy that was the head of Vanguard. And someone asked him, it was a discussion whether passive funds were destroying capitalism and they would prevent market efficiency from happening. And his answer was there, well, maybe, but right now, at 30-40%, there is still plenty of active investors out there that will do God's work to uncover alpha in them. And he said, well, maybe once we reach 90%, we'll talk again. And I think here is the same, right? At the end of the day, we need investors to set prices at the margin. And if we have enough there to do so, it should be fine. If we think going back now to the GameStop events, that's one of the potential, not dangerous, but the interesting things about these meme stocks. If you have a bunch of, I'm not going to call them dumb, but unsophisticated retail investors that believe that GameStop is worth $1 billion, it's very difficult for anyone to fight against those, right? Because they might be such a large block that they might be able to be there with a long position for enough time for you to give up or sometimes not even trying in the first place. Okay.
So today, as we have the system set up, if you have a large short position, you don't have to disclose.
No,
So,
unless you want to, but yeah.
so what is your argument for why you need this change?
So
disclose it?
here is just that
Do research.
exactly. I mean, that's for me to get tenure and everything. The idea here is that just like it's useful to know, for example, who are the major shareholders of a company, or how, for example, if corporate directors are selling shares, simply because their actions give us information about future prices that then becomes available to the public. And then it allows investors to have better signals and come up with new strategies based on this. The argument for disclosing what short sellers are doing essentially comes from this. Because research has shown that they are able to forecast future returns, it might be in the public interest to actually just disclose their actions after they shorted to the markets. So of course, I mean, if you're a large short seller, you hate this disclosure, right? Because you're essentially giving up your tricks to the market or to the wider public, okay? But at the same time, I mean, if you are a large short seller with a good reputation, this might actually be good, because rather than just being you trying to convince the markets and so on, you know that this information would be released. And remember that unlike with hedge fund activists, often a large short seller doesn't really know about the actions of others unless they communicate. So maybe this will also be a good idea to even magnify the impact of people. And again, here I'm assuming that many of those short sellers are doing good work of uncovering information rather than manipulating, and let this be another signal to everyone else. Okay, so at the end of the day, I mean, thinking about from a statistical point of view, it's just another price signal that research has shown it's useful to forecast prices, but right now it's not easily, it's not known, or you really need to spend a lot of resources to uncover them. Okay.
Through your, I think one of your earlier slides, you were walking through how you got the index fund and then short sellers are borrowing. And in order to enter into a short position, they need to offload, that position they borrowed.
Mm-hmm.
Who are they selling to? These, it's not other index funds.
Well, as usual, that's kind of like the answer to many of our MBA students' questions. For every seller, there is always a buyer at a certain price, right? So, and here, I mean, okay, if we have lots of short sellers trying to do the same thing at the same time and buy, that's when the short squeezes take place. So it happened with GameStop, or I showed you that it didn't, but that's what people said about GameStop, but it happened in 2009 or 10, that's what happened with Volkswagen. So there was one day that Volkswagen was the most valuable company in the world, simply because something happened there, and all these hedge funds that were shorting 40% of market cap realized that there wasn't enough shares for them to cover. Because think about this. Suppose that I borrow a share from Carlos and I lent it to you, or I sold it to you, you bought. In theory, you can lend this share to someone else that can actually short, right? So in theory, the same share was sold twice. So imagine, and that's exactly why we can have, say, more than 100% being short. Even though this is like a freaky event, in those rare situations, there isn't just enough shares for everyone, right? So that's when prices can really go up. And if they don't, I mean, if you as any seller, if you cannot deliver, you are subject to some fines. So in stock exchanges, we have this fail to deliver rules, and there's a bunch of research looking at that when bear stearns went down, because there, unlike with Lehman, you could do naked short selling. So lots of people saw the train crash coming. They shorted bear stearns, even though they couldn't find shares, because everyone, or many people were already forecasting that prices would go down a lot, which again led to problems of the back office and settlement and so on. Okay.
I want to get back to Kyle's question about the relation between passive and the short selling, right? And I know you have 2016 super great paper, and actually I have another paper I want to run through tomorrow.
Mm-hmm.
I guess it's kind of very good. So your paper basically says that these passive guys, they increase the supply, right, and make more shares available to short sellers, so make short selling easier, right? But actually, if you think about the covering side, it makes it more difficult for the short sellers to cover when the firm is having a lot of passive. Or because these guys will not sell when you as a short seller you want to buy, right? So this actually can be quite tricky, like in terms
True.
of
True.
impact of passive on short selling.
Yeah, I agree. So I think, yeah, I talked about how they would affect the supply side, but at the same time, I mean, on the demand side, if there's too much passive, maybe there's no one that, I mean, no one can force ETFs. Oh, sorry, if prices go down, a buyer is not required to buy if they're an ETF, right? Even if it's a good deal.
Yeah, so there are two supplies because there are two markets, right? There's the equity lending market, like real paper, but also when the short seller try to cover, they need to buy them on the equity market, and the passive can be one part in that market, and if you have a lot of passive, that supply will increase. So the overall impact of passive on short selling is actually quite tricky. Right?
Yeah, so, okay, there's a theory paper from that. So Adam Reed has this paper that he looks at the equilibrium in both, right? Because this is a cool economic theory paper because we have the market for the actual stock and the lending market, right? And both are related in a way. So we need to, and the price of the underlying stock is also affected by what? By the lending revenues and the potential, which is a function of the characteristics of who owns the shares, because some are more willing to lend than others. And I agree, I mean, that's a very tough problem to crack because one, the characteristics of the short selling market, if you paid attention to the talk, remember that on average, even though we have about 20% of market cap available to lend, only 5% on average are actually lent. Well, from basic economics, what we know, if there is more supply than demand, prices should be what? Zero, right? And here we don't have that. This comes because of frictions. So this market in the US is very opaque and over the counter. So there are searching costs to try to find who shorts or not. But still, I mean, modeling then the supply and demand of the equity lending market, it's more difficult because the supply curve is not like a nice slope like we learn in Econ 101. So we have to take into account the kinks and estimating this is a bigger pain in the butt and so on. Okay? Yeah.
I know close to nothing about this, so this question could be done. If there's a mandatory disclosure if you have large short positions.
Only in Europe, yes.
Yeah, no, suppose that it becomes an States. It's unclear to me that this is just unequivocally bad for the people who have the large shorts. Because if your argument is we need to listen to the short sellers, they're onto something. And if you have some kind of investors that are just, for example, like me, I'm going to use a heuristic, I know nothing. So one heuristic that I use is that, is there a big hedge fund that's shorting this particular stock? And then I short accordingly or I dump my stock. So isn't that beneficial to the big hedge fund who has a shorting position?
Well, remember that if this large hedge fund has already shorted, right? If everyone follows this heuristic conditional on announcement, what's going to happen? There's going to be a higher demand for selling. And this might depress prices to convince what? The buyers that are buying from the short sellers to do so. And this will benefit what? The original short seller in the first place, which is good, right? So that's an argument for why the large short sellers would want to do that. Okay, but what happens is sometimes what the large short sellers also want is to avoid the crowding of a position. Even they might say, even though they were the first ones to get in, suppose then that I'm right, I don't know, Herbalife sucks and I short it. You see what I'm doing and decide to do the same. But then what's going to happen? At some point, suppose that by the time the FTC decides that yes, Herbalife is a scam, and then I want to realize my profits and close it. Now, I mean, you are probably going to be doing the same thing as well. So we are going to be competing together. Even though we started the positions at different dates, we would all be trying to do what? To close them at the same time. Okay, and this might actually lower my profits when I close the position, which might be something that the hedge funds don't like. And it's similar to what happens, for example, with mutual funds. So sometimes, I mean, investors, they don't want to disclose their positions to avoid what? The copycats, okay? And yeah, it's kind of this argument in that. Again, and this is complicated because I'm trying to sell these arguments, assuming that not only that people are rational, but that we understand well these differences of opinion between investors and when they want to buy and when they want to sell. And that's what makes, I mean, from research point of view, interesting, but complicated, because we really need to have more data that would allow us to infer a little bit what are the opinions. We need to know when those people are actually trading. And also, for example, it's very different than if Bill Ackman shorts $1 million than say if I had the money to short $1 million, right? I mean, it depends also on reputation and all of those things to see who can convince the rest of the market that it's a good idea to do so. So I guess you following your heuristic would depend also on the credibility of the signal in the first place, right? And at the moment, we have no idea. We know that looking at the aggregate signal, so just the aggregate short selling is a useful heuristic, right? At least maybe until the last couple of years where the alpha of short selling has come back to being zero. But yeah, make sense?
All right.
Are we done?
Thanks,
Cool.
Pedro, again.
Thank you, everyone.